Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about what to look for in the Fed meeting today. I want to thank our sponsor, Rocket Clothes, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here in beautiful Boca Raton.
Boca Raton, and you're wearing like a thick sweater, it looks like.
Yes. What? My voice. Here I realized when I was coaching high school basketball, I was constantly yelling and screaming just to get the kids to do the right thing. I was never yelling at the refs. But if you're ever talking about economics and you don't have a mic and you have to project out and you have to do a whole presentation within 20 minutes,
this was last night.
Pushing the limits of your voice because you're projecting out as high as you can. So I'm trying to keep as warm as possible so I could speak.
Oh, okay. Okay, this makes sense. I'm like, Boca Raton, not exactly cold. Okay, we have a lot to talk about. Fed Preview Day. It is, when this goes live, it'll be Fed Day. There's been a lot going on, and you think that it's not so much about, it's not like you're expecting him to lower rates. It's in the Q&A. So let's talk about what you're looking for.
So this is the fight now. So we take the first 4 months of economic data and we just throw it aside because now we're entering a whole different phase of this cycle. And what the Federal Reserve has talked about already is Powell doesn't seem like he wants to do preemptive cuts until he sees the labor market breaks. This is different than my labor over inflation talking point because he feels that the size of the tariffs are big and he doesn't want to ease monetary policy going into that because he believes inflation can be more persistent in that environment. This is kind of what they saw during COVID. So they've raised their inflation expectations. All the inflation data that we've dealt with before is irrelevant. It's what's going to go out in the next 12 months. Then there's Fed presidents who've already said, we want to front load rate cuts to kind of get ahead of this damage. So that now it gets interesting. For every Fed meeting now is going to get more and more interesting depending on what the data says. Because it's already kind of too late. Even if we did trade deals in the next week, we're going to get some of the impact of not having the global trading system work. So we're going to go into this thinking, is Powell going to say, listen, I'm not cutting until we cut rate, until I see labor market breaks, or as soon as we see things getting weaker, we might try to get ahead of it to help our dual mandate. I think that's what we want to hear. Are they going to let the recession happen to combat this type of a shortage, or are we going to basically try to get ahead of it? And that's the battle between Trump and a few Fed presidents and Jerome Powell and other people that have his mindset.
So from your perspective, what is the best route? What's the best scenario for us to get lower rates? Is it that the labor market breaks? Is that the fastest thing? Is it that we go into a recession? Like, what can people think if they want lower rates? What is that best path?
It goes back to this second article that I wrote for HousingWire. Economic data outperforming the estimates about where the bond market should be with Fed policy means yields can stay elevated. The last few days are a great example. Since last Thursday, we've had a series of economic data beats. 10-year yield rose. We're at the 435 level today. This is Tuesday morning. This looks about right to me. But if you saw economic weakness and the Fed starts talking about, okay, well, we want to kind of, take away our moderately restrictive policy and get something more neutral. See, the whole argument has been about how to get to neutral policy. We've never dealt with, the labor market's breaking. What do we need to do if the labor market's breaking? This is why the next 12 months are going to be very interesting. Because even President Trump has talked about, if we have a recession, it's short term, something like that. Everybody's kind of gearing up for this event. It's how you deal with this event. And Waller and some other people have always talked about, hey, if the labor market is breaking, we want to get preemptive rate cuts in. If there is no labor market breaking, if we have inflation and the economy stays stable, right, with no job loss, that means rates could stay elevated for a longer period of time until the trade war situation deals itself. But here, we just want to get a clue on what's his threshold, right? And to me, it's just from what Powell has talked about, it doesn't seem like he doesn't want to talk about preemptive rate cuts on something that could happen. But we want to hear, okay, if you start to see jobless claims break, what are you going to do? Um, a few times the bond market tries to get ahead of the Federal Reserve. I mean, they always try to get ahead of the Federal Reserve, but in the past few years, they really have. Like last year was a great example. We broke the order line for a very small amount of time because the bond market was assuming that labor market was breaking. The Fed had to sure that didn't happen. So any kind of clues about, well, we will try to help the economy if the labor market is breaking, any kind of direction into that can be received well. What you don't want to hear if you want lower rates is, by the way, we're not going to do anything until we get an idea of where the policy is. And even if the labor market starts to show weakness, we want to stay moderately restrictive because, our job is to make sure inflation doesn't persist or go or longer in that category. There's where I think now you're entering a whole new 12-month phase of this economic cycle of this dealing with the Federal Reserve. And President Trump already talked about, when they asked him, do you want to fire Powell? So why do I need to fire him? He's done very soon anyway. So the question is, if this happens, does the shadow Fed start to become more of a story going out the next few months, where that person says, "Hey, listen, when I'm Fed president, we're cutting rates aggressively. Don't put all your eggs into Powell's basket. Help is on the way." It gets a little bit more complicated now because of the political economics that are going to this, because of the possibility of a shadow Fed, because we're not exactly 100% sure how this trade war is going to work out.
Right.
So again, confusion, chaos, we're not sure, but any kind of direction to, well, if the labor market starts to really break, we'll be a little bit more dovish. That's what you kind of want to hear. And if it doesn't happen, if the economy still moves forward, then this discussion is somewhat irrelevant. But even if there was no tariffs, they were still going to be very, holding their ground, maybe neutral policy. We want to stay modestly restrictive. There's still this hesitation to kind of get rate cuts going. Only 2 rate cuts were priced in for 2025. So we want to see how Powell talks about future economic weakness tied to the labor market.
So let's talk about, the unemployment rate, because from my perspective, you said, January through April was one phase. Going forward, May forward is another, right? Because we do have these changes. It seems like on the freight side, if you look at those kind of the news from those people, if you look at like what's happening in ports, it feels like we are about to have some major layoffs there, because we know that the last ships have left China with, untariffed goods, and now there's very few ships in like the busiest port in on the West Coast, all of that. So it seems like we're going to see layoffs from dock workers, truckers, anybody involved in that freight business. Do you think that that's enough to cue Powell that like those kind of layoffs are gonna lower interest rates?
To me, Jerome Powell is always going to work off jobless claims. And we always
Okay.
said 1.5 to 2 million people lose their jobs each month. It really depends on the consumption data, as we can see in the last few months. The U.S. consumption data held up, jobless claims held up. The unemployment rate has risen from 3.4% to 4. It's still at those levels. One thing to think about in the future, if the labor force isn't growing, the unemployment rate can stay lower than what people think in that context. So I think, to me, jobless claims in the consumption data is really the key going out of the forward, because the Fed has basically revolved itself on that portion of GDP and that labor trigger right there. So are the dock workers enough to put us? No,
Right.
that's not. But if consumption starts to fade and then the general economy starts to, slow down in itself, and you don't need those workers. There's where you start to get into recession, because once a recession happens, listen, jobless claims break. There's nothing you can do about it. This is how it's
Yep.
looked like, since the Peloponnesian War. But here, subsectors of the economy can create a higher unemployment rate. Like we always talked about before the trade war, Godzilla tariffs were in place. Um, we said, okay, so we're firing federal workers. We see that in the
Right.
data. Uh, State workers are still being hired, but that growth has already slowed down. In this context, going out in the future, if we're adding another variable that's a negative, then it just raises the unemployment level pool. And if those people can't find jobs right away, there's how you get 4.5% to 5% unemployment rates. Fed President Williams has already raised his unemployment rate targets to 4.5% to 5% already. The Fed kept that unemployment target very low just in case if something bad happened. And they look at this as a negative for the economy going out. So if that's the case, the question, you could be in two camps. Why not front load rate cuts to try to help this?
Right.
Or, by the way, listen, it's not our responsibility. This is your guys' trade war, so we have to be careful of inflation. So you're in two camps. You're in two clear camps now. So what we want to see today in the Fed is, how do they deal when the data is breaking? Because it seems like if the data isn't breaking, they're just going to kind of stand pat and take it. But clearly, the growth rate of inflation on the data lines have been slowing down. We have two handles on CPI, PCE. If the Fed stuck to its original policy, the Fed funds rate is 3.5%, easily by now, not no question. But they're being very mindful on what can happen with this trade war, and so we just want to see, where's your trigger? When do you start to see, so the bond market can get? And then the counter is, Powell's going to stay hawkish. President Trump is, don't worry, we'll help is on the way. And then it gets into this chaotic 12-month period. Shadow Fed president. What's policy in the future? How does Powell deal with it? What if there's major dissents? We've talked about the civil war within Fed presidents a few weeks ago. So you got a lot of variables that are just not normal
Right.
in a normal cycle. And we have to look at it now going out 12 months, because whatever happened the first 4 months is pre-trade war. Now it's, okay, we'll see where we take it from here.
So, you and I have talked about like soft data has been showing one thing, hard data has not shown it yet. How long before some of those things shows up in the hard data? So, like, let's talk about dock workers specifically. Say they start losing their jobs this week, or next week. How long does that take to get into the data where it would make a difference?
Everyone is gearing up for summer, for some of this data line to hit, right? So obviously the consumption data and everything was fine for the first 4 months, but it looks like everyone's kind of timelining the summer. If there are no deals and we just push forward with it, we should be seeing some of the weakness in the summer months out here. So there is a lag to this portion, but it's got to, once you have consumption data weaken, that's a whole different story. The
Okay.
consumption portion of GDP, the thing that the Federal Reserve has constantly told us they track, has held up well for 2 years now. But going out in the future, is that going to be the case? If there's shortages and X cost now is 2-3 times, are you going to pay?
Right.
There's all these things that we're starting that phase into May, but July and August to me are going to be a little bit more telling on what happens if we get no deals. If we get deals, then the marketplace might presume to show some leniency onto the future, of a little bit more clarity on trade. But outside of that, kind of gear yourself up for the summer to see if the data line gets weak. Because right now, some of the data lines beat, bond yields went up. That's how it should act.
Yeah. So what does it mean that China is such a, when you think about all the things that we consume, so many of them come from China. So it feels like even if we got other trade deals, if we don't have a trade deal with them, it feels like consumer costs go up, so consumption is going to go down. So it feels like that's really the key.
we're putting tariffs on our three big trader partners. Um, China sells so much to us, so the White House's game plan is it's going to impact them a lot more than us because we'll consume other things. But China has 5 to 10 million jobs that are relying on this. So they're basically trying to wait them out. The Chinese are basically saying, listen, we've been doing this for thousands of years. We have the real long game here. So I think the initial response, and I'm pretty sure this is Peter Navarro's thinking, that China would fold because they've had a weak economy. Their 10-year yield has a one handle. They're stimulating their economy. So it is interesting to see if President Trump starts to take, well, China's doing all these things to stimulate their economy. Why isn't our Federal Reserve trying to do this?
Mm.
Well, that's one portion, but then you can say, well, the government is firing workers and withdrawing spending on certain things. So this is complicated, right? We're doing this to ourselves, so we're throwing a lot of variables into an equation in a very short amount of time. So we need to keep a mindful outlook on how is this all going to impact everything going out in the future. So this is why President Trump wants lower rates, because we talked about this back in November. What does President Trump want? He wants three things: lower dollar, check; lower oil prices, check. It's not because we're drilling more. Saudis, assuming that President Trump made a deal with the Saudis on here, there's a OPEC supplies going out there. Oil prices are below 63. You're starting to get oil companies here saying, we're not going to be producing as much oil because the price is so low. So you've already got that. So this is OPEC supply related. But check, number two. Now it's the 10-year yield and the Fed funds rate. At first he said, we just want the 10-year yield lower, but he really wants it. He wants rates to go lower because he saw what happened during COVID, right? He saw what happened during the mini trade war in 2018 and 19. Lower rates consumption gives the American consumer, because we're a consumption-based economy, a little bit more flexibility during a trade war. So it's going to get really, really chaotic over the next 12 months if there is no trade deal. So we have to see how the Federal Reserve responds to all pieces of data that starts to get these the trade war impact into them.
So we've been talking about the Fed, understandably. They're like, I think I've heard you say before, they're about 65% of where mortgage rates always are, is dependent on the Fed. Let's talk about the bond market, though. What does the bond market need to see? Where will it get ahead of the Fed in this environment?
So remember, the slow dance, the 10-year yield and 30-year mortgage, 65 to 75% of where the 10-year yield can range within an economic cycle is still Fed policy. So the spreads had gotten worse during the trade war. It's gotten a little bit better recently. The bond market, if it sees weakness, if it perceives to see weakness again, it can drive yields lower. But a really good example is the last few days. The ISM service, PMI data, labor data, they're all beat. So 10-year yield went up to 435, just right where I believe it should be trading. Now, the question is, does the bond market say, hey, listen, we're not sure if the Fed's going to cut rates, even if the labor market breaks? See, that's a new variable. Last few years, whenever the economy is weaker, until the 10-year yield starts to go lower, we start to, talk about recessions and everything, and then it reverses. Here, I think a little bit more clarity can give bond traders a little bit more. And this is why I do believe, I know a lot of people don't believe in the shadow Fed present theory, but imagine if Powell is very, very hawkish and the economy is getting weaker. You think President Trump's going to sit back and just say, oh, we're going to take this? China's doing, he's already talking about all these other countries are cutting rates and everything, and why are we at a disadvantage? That will accelerate into a new phase. The question is, assuming it's Kevin Warsh, does Kevin Warsh start to go on the media tour and say, don't worry, everyone, America, Powell's not behind you. We're going to cut rates. We're going to help the American people. Then you start to get into this whole, oh boy, conflict, right? Where we'll pit, Trump and American people versus a hawkish Federal Reserve that, So that's why it's key to see if he admits, hey, listen, if the labor data gets weaker, we'll act. Because that's what he said before. He's always used that line. We have the ability to act if the labor market breaks. The labor market hasn't broken yet. So even though
That's
this
the
is the whole
key.
paper, rock, scissors thing, this is a little bit different than that now because of the trade war and the inflation expectations have risen. Even though the Federal Reserve believes this is a very short-term thing, it makes it much more complicated for Powell and them to justify being hawkish if the labor market breaks.
Whew, we have a lot going on. Logan, thanks for being on. Thanks for explaining it all as we head into this Fed meeting day so that people can listen for themselves. Of course, HousingWire will be reporting on it. I'm sure you'll be writing analysis on it to explain further. But thank you for all of this morning. It's very helpful.
Pleasure.